Europe's recent Treasury reduction reflects routine reserve management rather than sudden financial panic. Data from Treasury International Capital reports show monthly adjustments across foreign holders regularly. In a recent reporting period, European institutions reduced United States Treasury holdings by $9 billion. Such changes occur frequently as central banks rebalance portfolios based on yields liquidity considerations. Treasuries remain core reserve assets, providing safety depth and convertibility during global uncertainty. However, rising yields alter valuation profiles, encouraging some holders to shorten duration exposure. Higher interest rates reduce prices of existing bonds, creating mark-to-market accounting pressures. Central banks therefore manage interest rate risk to preserve balance sheet stability over time. Europe's Treasury sales coincided with broader global portfolio adjustments during tightening cycles. Multiple regions adjusted reserves responding to currency hedging. Costs and funding dynamics. These flows do not indicate coordinated abandonment of dollar assets by Europe. Instead, they reflect incremental positioning within established reserve management frameworks. At the same time, gold repatriation discussions resurfaced across several European countries. Gold repatriation refers to relocating physical gold reserves to domestic vaults. Germany initiated major repatriation programs beginning 2013. The Bundesbank cited transparency, security, and public confidence as motivating factors. Germany successfully moved significant gold holdings from New York and Paris. Other countries, including Netherlands, Austria, Hungary, and Poland, followed similar paths. These actions unfolded gradually over years, not as emergency responses. Gold remained a symbolic and strategic reserve asset within diversified portfolios. Repatriation does not imply selling gold, but changing its storage location. Central banks still value gold for diversification, crisis insurance, and credibility. Geopolitical tensions increased attention on reserve sovereignty after sanctions. Episodes Frozen Reserves highlighted counterparty risk within the international financial system. Consequently, central banks reassessed custody arrangements for strategic assets. Gold held domestically eliminates reliance on foreign custodians during crises. This consideration gained prominence across emerging and developed economies alike. However, repatriation does not equal rejection of international cooperation. Mechanisms. Most gold reserves remain stored abroad under established custody agreements. Europe's Treasury reduction and gold repatriation are therefore parallel trends. Both reflect prudent risk management amid changing geopolitical financial landscapes. Treasury holdings fluctuate monthly due to redemptions, maturities, and valuation effects. A $9 billion change represents a small fraction of total European holdings. Europe collectively holds trillions in dollar-denominated assets across sectors. Treasuries continue to offer unmatched liquidity for reserve deployment. Dollar markets remain central to global trade finance and settlement systems. Reserve. Diversification seeks balance rather than wholesale replacement of assets. Gold complements rather than substitutes. Sovereign bonds within reserves. Central banks optimize across safety, liquidity, yield, and independence objectives. Higher yields increase attractiveness of newly issued treasuries over older bonds. Thus, portfolio turnover occurs naturally as securities mature and are reinvested. Currency hedging. Costs also influence foreign demand for dollar bonds. When hedging becomes expensive, net returns decline for foreign holders. European institutions consider these costs when adjusting treasury exposure. Additionally, domestic funding needs can require reallocating foreign assets temporarily. Seasonal tax flows and fiscal operations also impact reserve levels. Treasury International Capital data captures these movements with reporting lags. Headlines often simplify complex multi-month adjustments into single events. Such framing can misrepresent gradual portfolio management as abrupt shifts. Historical context shows similar Treasury sales during previous tightening cycles, yet dollar dominance persisted due to lack of comparable alternatives. Euro-denominated assets lack equivalent depth liquidity and global acceptance. Thus, diversification occurs at margins rather than systemic scale. Gold repatriation debates often resurface during periods of uncertainty. Public interest intensifies when trust in institutions faces scrutiny. Central banks respond by emphasizing transparency and control. Holding gold domestically reassures citizens about national wealth security. However, operational considerations limit feasibility of full repatriation. Security storage and insurance costs rise with domestic holdings. Therefore, central banks balance domestic and foreign storage locations. Policy statements consistently frame repatriation as logistical, not political. European officials avoid linking gold movements to Treasury sales explicitly. Reserve management decisions are compartmentalized across asset classes. This separation prevents misinterpretation of strategic intent. Markets interpret actions through data rather than rhetoric over time. So far, Treasury yields reflect macroeconomic conditions, not foreign panic. Demand remains strong at auctions despite occasional volatility. Global savings continue flowing into dollar assets seeking stability. Gold demand rises concurrently as hedge against tail risks. Both assets coexist within diversified reserve strategies. Understanding this nuance prevents overreaction to isolated data points. The financial system evolves through gradual adjustments, not sudden breaks. Europe's actions illustrate cautious adaptation within established monetary order. Observers should analyze trends across months, years, and institutions. Single figures gain meaning only within broader context. Reserve management prioritizes resilience, optionality, and flexibility. Neither Treasury reductions nor gold repatriation imply systemic rupture. They signal prudent preparation amid uncertain global conditions. This analysis sets the foundation for understanding deeper structural shifts. Subsequent developments will depend on policy data and geopolitical stability. Market participants monitor Treasury International Capital data to assess foreign demand trends globally. Monthly TIC reports aggregate transactions reflecting purchases, sales maturities, and valuation changes across holders. Interpreting TICs figures requires caution due to revisions, timing effects, and custodial reallocations complexities. Sales may reflect maturities rolling off rather than discretionary selling. Decisions by institutions. When bonds mature, principal repayments reduce. Reported holdings without market impact. Implications. Valuation effects also matter because rising yields lower prices reported in dollar terms. Currency movements can change reported values even without transactional activity occurring. Therefore, analysts adjust raw data using duration price and exchange rate controls. European holders include central banks, sovereign funds, banks, insurers, and asset managers combined. Each cohort follows distinct mandates, risk tolerances, and accounting frameworks influencing behavior. Central banks prioritize liquidity, safety, and policy flexibility over maximizing returns considerations. Asset managers respond to benchmarks, client flows, and relative value signals dynamically. Banks manage balance sheets under regulatory constraints affecting securities inventories. Insurers align assets with liabilities, optimizing duration, matching and solvency ratios. Aggregated numbers mask heterogeneous motivations across these different institutions' groups. Hence, attributing intent requires supplementary evidence beyond headline figures alone. Yield differentials influence cross-border flows as investors chase relative returns. When US yields rise, hedged returns may still disappoint foreign investors. Hedging costs fluctuate with interest rate spreads and currency volatility conditions. elevated hedging costs can temporarily reduce attractiveness of dollar bonds. In such cases, reallocations towards shorter maturities or cash equivalents occur. Repo market conditions also shape demand for Treasuries as collateral instruments. Treasuries provide high-quality collateral supporting funding and derivatives markets globally. Changes in collateral demand can drive buying, even amid broader selling narratives. During stress, Treasuries often rally. Reflecting flight to quality dynamics historically, recent episodes show mixed behavior as inflation concerns offset safety demand. This unusual combination complicates interpretation of flows and pricing signals. Central bank balance sheet policies materially affect Treasury market supply, demand, quantitative tightening increases net supply, requiring absorption by private investors. Private demand adjusts through yields until clearing levels are reached. Auction metrics such as bid-cover ratios inform near-term demand strength. Recent auctions showed solid participation, despite volatility suggesting resilient appetite. Primary dealers absorb supply distributing risk across secondary markets afterward. Dealer capacity remains constrained compared to pre-crisis norms, influencing liquidity. Regulatory leverage, rules, limit balance sheet usage during peak issuance periods. These constraints amplify yield moves during concentrated supply windows occasionally. Nonetheless, market functioning remains orderly with settlement clearing, operations stable, international investors diversify incrementally balancing concentration risks pragmatically. Dollar assets remain dominant due to network effects and market depth. Alternatives lack comparable liquidity, transparency and legal protection scale. Thus, diversification occurs gradually, not abruptly across reserve portfolios. Gold serves complementary role, providing non-liability asset characteristics benefits. Its price behavior differs from bonds offering diversification during regime shifts. Holding gold domestically addresses custody sovereignty considerations, not allocation changes. Public communications emphasize operational reasons to avoid political misinterpretations. Historical precedents show similar discussions during previous stress cycles globally. Outcomes typically involve partial adjustments rather than wholesale transformations. Therefore, current developments fit established patterns of cautious adaptation. Investors should track cumulative trends rather than isolated monthly movements. Contextual analysis prevents misreading prudent management as alarm signals. Understanding mechanics supports informed assessments of global financial stability. This perspective prepares viewers for deeper discussion on implications ahead. Looking ahead, these reserve adjustments highlight resilience within the existing global financial architecture. Markets adapt through incremental changes rather than abrupt breaks in confidence mechanisms. Treasury markets continue functioning as primary liquidity anchors for international capital. Flows, gold maintains complementary status, offering diversification, credibility, and long-term stability benefits. Together, these assets balance risk, liquidity, sovereignty, and confidence, objectives simultaneously. Policy coordination and transparency reduce misinterpretation of routine reserve management actions. Future TI data will likely show continued month-to-month variability across regions. Such variability reflects operational needs rather than directional abandonment of dollar assets. Central banks prioritize flexibility to respond quickly during shocks and disruptions. Reserve composition therefore evolves slowly alongside macroeconomic and geopolitical developments. Investors should contextualize headlines within historical patterns and structural incentives. Understanding these dynamics prevents emotional reactions to isolated data points. Global finance rewards patience, analysis, and disciplined interpretation of information. If this breakdown helped clarify complex macro signals, consider subscribing for future updates.